find you if you like. Well, I'll tell you more. Don't let the day get the better of you. When the evening comes, there's so much to do. You better put on your best and wear a smile. Just come along with me a while. 'Cause I tell you, I love the everything is fine. Lights on the road. I love the where we can go.
Good evening, everyone. I'm Brian Trumbore with your nightly review for Wednesday, November 28th. It's being taped about 4:05 p.m. Eastern Time. Of course, that was the lovely Petula Clark. I Know a Place, number 3 from 1965. I know you can't see her picture real clearly. And if I have a moment at the end, I'll just briefly mention this is Curt Flood, if you can't see that real clearly, and I'll explain that later if you don't already know what it's about. So, we had some late breaking news. I'm a little scattered here, trying to decide what to lead with. So we'll lead with the stock market, which had a big reversal. It was down 100 points earlier today, finished up 106 on Dow Jones, up 0.8%. As a matter of fact, all three major indices were up 0.8%. So the Dow was down 100 this morning on Fiscal Cliff Talk, and then rallied back on Fiscal Cliff Talk. And also in the last half hour, an article that came out at 3:24 exactly by John Hilsenrath of the Wall Street Journal, who starts off saying Federal Reserve officials are likely to continue buying long-term mortgage-backed and treasury bonds in 2013 as they confront a slow-growing economy and threats of new turbulence and uncertainty related to fiscal policy. And this will most likely come up at the December 11, December 12 Federal Reserve Open Market Committee meeting. It's no real surprise, but when a story like that breaks late in the day, it has an impact. We all know that the Fed is going to continue to keep buying bonds because, as Hilsenrath points out, President of the Chicago Fed, Charles Evans, said the Fed should assure the public it will keep short-term interest rates near zero as long as the unemployment rate is above 6.5% and inflation is projected to remain below 2.5%. All right, fiscal cliff. The attempt to avoid $500 to $600 billion in tax increases and spending cuts that would send us hurtling back into recession, with a huge impact on global growth, a fact often forgotten in the debate. The market was down this morning because last night Illinois Democratic Senator Dick Durbin said Medicare and Medicaid should be part of future debt reduction efforts, but not now. Yes, he said in the speech, changes must be made to ensure long-term viability of Medicare, Medicaid, and Social Security, but the conversation should not be part of a plan to avert the fiscal cliff. Then today, President Obama said, I'm asking Americans all across the country to make your voice heard, especially over the $2,000 tax increase per family that would occur if the U.S. plunged over the fiscal cliff. House Speaker John Boehner continues to say he is willing to put revenues on the table in the talks by limiting deductions, but not higher tax rates on the wealthy. Erskine Bowles of Simpson Bowles fame said today he is discouraged by the slow pace of the negotiations and the distance between the sides on both taxes and spending. I think the probability is we're going over the cliff, Mr. Bowles said. I'm hopeful, but boy, I wouldn't put me down as optimistic. That was from the Financial Times. An editorial in the Washington Post, an excellent one, summed up some of the issues. The Post Greg Sargent had reported that union leaders and other liberals came away from a White House meeting and encouraged that administration officials agree that entitlements should not be part of the negotiations. They expect taxes to go up on the wealthy and to protect Medicare and Medicaid benefits, one attendee said. They feel confident that they don't have to compromise. Now, this is the Post. Don't have to compromise? Since 60% of the federal budget goes to entitlement programs such as Medicare, Medicaid, and Social Security, there's no way to achieve balance without slowing the rate of increase of those programs. Mr. Obama has understood this since at least 2009 when he told the Post editorial board that he would tackle entitlement reform. What we have done is kicked this can down the road. We are now at the end of the road and are not in a position to kick it any further, Obama said then. That's 2009. We have to signal seriousness in this by making sure some of the hard decisions are made under my watch, not someone else's. The Washington Post. 4 years later, has the moment arrived? Since his re-election, Mr. Obama has fueled a campaign-style effort to pressure Republicans to give ground on taxes. That's fine, but it won't be enough. At some point, he has to prepare the American people and his own supporters most of all for the hard decisions required to put the country on a sound financial footing. That means spending cuts, it means entitlement reform, it means compromise, it means a balanced solution that will please neither House Speaker John Boehner nor Senate Majority Leader Harry Reid. Only one person is in a position to make it happen. So again, whatever short-term bridge deal they come up with before year-end, and there's not going to be a final grand solution by year-end. No freaking way. But they have to come up with some kind of bridge deal before year-end to end run the fiscal cliff and sequestration. It better be authentic with real timetables and a real target for reducing entitlements, or the market will crash. Period. The market will crash without a legitimate short-term bridge deal by year end. I'm going to keep repeating that, and also the fact, of course, we have the debt ceiling debate, which is going to hit full force. It now looks like in February. It doesn't seem as if Treasury can extend it any further. So this whole thing is coming to a head quickly. We did have some economic news today. New home sales for October fell slightly when a decent increase was expected. Wouldn't read too much into that. IBM has these online shopping monitors. So they said sales at the largest retailers jumped 30% on Cyber Monday over last year. That sounds great. But IBM didn't provide any actual dollar sales figures. And then they said the average customer's order fell 6.6%. So what's up with that? Overseas, the China Shanghai Composite fell again to 1973, another almost 4-year low, though industrial profits in China appear to be making a comeback. Gold closed at $17.19, down about $20. Oil fell below 87, closing at 86.70. Remember yesterday the Organization for Economic Cooperation and Development, the OECD, did cut its growth outlook for 2013, and if you're going to have a weaker economy worldwide, that certainly should translate into weaker demand for energy. In Greece, more time was bought, cans kicked. But there are still major issues. Number one, can the Greek economy grow? Only way the debt is going to be reduced to this new target of 124%, which is really 126% when you look into the numbers, by 2020. And to prevent a Greek exit from the Eurozone is the economy has to grow. The other issue, as mentioned yesterday, and was the focus of stories in today's papers, is Eurozone governments will almost certainly have to accept losses on their loans to Greece. And we're talking not 2016, but more like months. Governments won't keep throwing money down this rat hole. Their people won't let them. The pressures are going to build, I can guarantee you, after the first of the year, to let Greece go. Greece needs growth, and the current economic projections seem to be way too rosy that the Eurozone finance ministers and the IMF put together. The German opposition has been seizing on this, and it will be a big flashpoint for next year's elections. In Spain, the European Commission has approved the Spanish government's plans to restructure 4 troubled banks, among them Bankia. They will no longer be able to lend to property developers and must refocus their business on loans to households and small business. And in turn, they are going to receive, as part of a recapitalization, 40 billion euro in total from Eurozone bailout funds. Bankia is the largest of the 4, and it announced today that it will now have to lay off 6,000 employees. Of course, Spain already has 25% unemployment. That is, for Bankia, 28% of its workforce, and shut 39% of its branches. The banks are going to be restructuring by, in part, selling their most problematic loans to the Spanish government's bad bank. In Syria, there was a twin suicide bombing that I thought was significant today in a commercial district in Damascus where there were supposedly no troops. A classic twin suicide car bomb attack, the hallmarks of an Al-Qaeda-like group or Al-Qaeda itself. Hardly the classic rebel opposition that you and I thought had first formed in Syria. I mean, this war is so lost in terms of the United States being able to influence the outcome and have a say in any new government, whatever that turns out to be. And that's all part of Obama's legacy. New Jersey Governor Chris Christie continues to be in the news. You'll recall he initially made a Hurricane Sandy claim with the federal government on damages of $29.4 billion. Well, now today he is seeking a further $7.4 billion to reduce damage from future hurricanes and floods. It was yesterday that Governor Andrew Cuomo had requested $32.8 billion for actual damages and $9 billion in prevention and mitigation. So 42 plus 29 is 70 plus another 7, 77 billion right there. Actually about 78, 79 billion. It's rounding off, rounding down. Christie said he will take on new powers and take away local towns' power to grant easements to homeowners objecting to new dunes blocking their sea views, and would not rule out using government powers to purchase properties it believed were in the wrong place. Christie said, "I have to protect the Jersey Shore both as an economic engine and as a cultural engine," so he's looking for a massive dune rebuilding plan, which the federal government had actually approved prior to Sandy, but of course there's a budget crisis, which is why this 77 to 79 billion that both Cuomo and Christie have requested is going to run up against some headwinds. Finally, Marvin Miller passed away yesterday. He was 95. Miller was the Major League Players Association union chief from 1966 to 82. An era that saw the first real labor strife in baseball, but one that ushered in free agency, starting with the Curt Flood case in 1969 when he challenged, with Marvin Miller's help, the reserve clause. He lost, but the process led then to the decisive 1975 Andy Messersmith and Dave McNally challenge that finally led to the owners capitulating and the advent of free agency. Consider that back in 1966, when Marvin Miller became involved, the minimum salary for baseball players was about $6,000 to $7,000, and today it's $480,000 with an average of $3 million. Baseball's revenues have gone from $50 million in 1967 to $7.5 billion today. Marvin Miller was a giant of baseball, perhaps the key figure, most would say, of the last 40 years, and it is a crime he is not in baseball's Hall of Fame. That's all for today. I'll be back with you tomorrow. Keep the men and women of our armed forces in your thoughts and prayers, and for more stuff, go to stocksandnews.com. Take care.
Sure, you'll be tapping your